This presentation is about determining who's a dependent and who's not a dependent. To give you a little history of the definition of a child in the tax code, prior to 2002, there were various definitions of a child depending on what part of the tax code you were looking at. So if you were looking at something like the earned income tax credit, you would see one definition of a child. If you were looking at the requirement to file a tax return and the requirement in what was necessary to determine a dependent. There was another definition of a child. So there were various definitions that existed prior to 2002. In 2002, Congress decided that they would solve this problem and create something called the Uniform Definition of a Child. So they created this change to the law that supposedly was going to be used as a uniform method of determining the definition of a child, regardless of what part of the tax code you were talking about. So it ended up being something that turned out to be more complex probably than they had originally intended. But I guess the problem was that severe that it required a complex solution to solve it. So now we have this uniform definition of a child, and it led to a lot of complexity that, unfortunately, for people that are learning the tax code for the first time, can be a little bit intimidating. But that's why we created the resource tool that we have, the qualifying child qualifying resident resource tool, so that you have a decision tree and a flow chart to go through so that you don't make mistakes in making this determination. So it's very important that you use that tool and not depend on your recollection to make that determination. Here are the lesson topics: claiming dependents, the qualifying child, and qualifying relative. Beginning in 2018, the deduction that was allowed on the personal income tax 1040 for each dependent went away in 2018 due to a change in the tax law initiated by Congress in that year. Prior to 2018, taxpayers were allowed to take a $3,000 deduction for each one of their dependents. And so beginning in 2018 and ending in 2025, there is no longer a $3,000 deduction for each dependent. However, so one might ask, okay, if the $3,000 exemption went away for dependents, then why even have dependents? Well, the reason is that there are many other implications of dependency within the tax code, such as determining critical benefits such as medical expense deductions, child tax credit, additional child tax credit, credit for the other dependents, earned income credit, child and dependent care credit, head of household filing status, and other benefits. So the dependency played into all of these other things as well as that one exemption. So even though the exemption went away, at least until 2025, or at least until 2026, it still exists in the tax code because it has a major impact on all of these other things, mostly credits. As I mentioned in my last presentation, determining whether somebody is a dependent or not can be very complex. There are various tests in the tax code that need to be conducted so that we can make that determination. The first test is the dependent taxpayer test. So the taxpayer or the spouse, if filing jointly, who may be claimed as a dependent by another individual cannot claim anyone as a dependent on their return. So if the taxpayer themselves are a dependent of somebody else, they are not allowed to claim a dependent on their tax return. But there is an exception. Of course, there's exceptions to everything. If the other individual is not required to file, then the taxpayer or spouse is not considered a dependent, so therefore they can claim other dependents. So if they're filing a tax return and they're not required to file a tax return by law, they're filing it for some other reason, such as to get a refund of their withholding or their estimated tax payments that they made, then they can still claim a dependent because they're really not considered dependents. It's just that they filed a tax return for some other reason other than because they were required to. Then we have the joint return test. So if a married person that already filed married filing jointly, they are not allowed to be claimed as a dependent. And we have the same exception here that we had in the last scenario, in that if somebody files a return, not because they were required to, but because they wanted to get a refund of their withholding, their tax withholding or their estimated payments, then they're not considered to be affected by this rule. So anybody filing MFJ is not allowed to be a dependent unless they file with this exception. The last one is the citizen or resident test. The dependent must be a U.S. citizen, a U.S. resident alien, or U.S. national, or a resident of Canada or Mexico. And here again, there's an exception. If an adopted child lives with the taxpayer for the entire year, now this is an adopted child, or the rest of the year after being placed for adoption, they pass the resident test. So adopted individuals do pass the resident test. Claiming a dependent. This is where things get a little bit murky. There are two types of dependents. First is the qualifying child, but unfortunately, it does not always mean that it is actually a child because it includes permanently and totally disabled adults. Then we have the qualifying relative. And this may not always be a relative because it includes qualifying non-relatives as well. So even though they use the term child and they use the term relative, those things don't always hold true. On the next bullet, dependency is not a choice. Now, a taxpayer can choose not to put a dependent on their tax return. However, if the dependent qualifies as a dependent, they don't have a choice as to whether they're a dependent or not. So for exceptions, you can see slide 9, which is coming up soon. The facts determine who can be claimed as a dependent. So it's really a matter of do they fit the dependent definition. You can also see the lesson for qualifying child and qualifying relative resource tool, and that lesson is the presentation that I'm doing right after this one. Qualifying child tests 1 and 2. So we have to test the relationship and we have to test the age. So as far as relationship is concerned, a qualifying child needs to be either a child, grandchild, brother, sister, qualified foster child, or descendant of any of those. Also, the half brothers and half sisters are included here, as well as step brothers and step sisters. So that's the relationship test. That's test number 1. The age test. The possible qualifying child would have to be under the age of 19 or possibly under the age of 24 if a full-time student. And also they would have to be younger than the taxpayer or the spouse. So that's another part of the age test as well. Or if any age when permanently and totally disabled. So the age really is not a factor when it comes to somebody that's permanently and totally disabled. They can be of any age. Test number 3, residency. Did the child live with the taxpayer for over 6 months? Number 4, support. Did the child provide over half of their own support in the tax year? Number 5, joint return. Did the child file a joint return? Same test as for the joint return test for all dependents. Did the child file a joint return? Yes or no? So what if we have a qualifying child of more than one person? The IRS tax code has what's called the tiebreaker rule. If more than one taxpayer qualifies to claim the child, then how do we handle that? When can they decide who claims the child? So either the parent can claim the child if the other qualifying parent agrees not to claim the child, or if there's someone other than a parent, such as perhaps a grandparent, that grandparent can claim the child if any qualifying parent agrees not to claim the child, first of all, and then the other taxpayer, for instance, the grandparent, would need to have an AGI that is higher than any of the parents. So that's the tiebreaker rule, and that's how that's handled. And again, that's covered in the resource tool as well. We're going to have a presentation of the resource tool after this. So my next presentation covers the resource tool. Here's more on the tiebreaker rule when more than one parent has the ability to claim a child. If only one taxpayer is the parent, then the parent wins the tiebreaker rule. If both parents claim the child, the custodial parent, the parent with whom the child lives, wins the tiebreaker rule. If a child is in custody of both parents, the same amount of time, for the same amount of time, say, let's say 6 months in one home, 6 months in the other home, the parent with the higher AGI wins. If none is the parent, if nobody is the parent, taxpayer with the highest AGI wins. And the AGI must be higher than any parent that could claim the child. So again, like we said in the last slide, if the other person, such as a grandparent, it would have to have, that person would have to have an AGI that's higher than the original parents. AGI, of course, is adjusted gross income. Let's go through some examples. Here's the first example. A household consists of an unmarried couple with their child who meets all the tests to be claimed as a qualifying child for either parent. Either parent can claim the child if the other parent agrees not to claim the child. So that's the first thing. Secondly, if the other parent claims the child, then the remaining parent must file as either single or head of household if the remaining parent pays more than half the cost of maintaining the home. Example number 2. This is a 3-generational household with a grandparent, a parent, and a child, where both grandparent and parent meet all the tests to claim that child. The parent has the right to claim the child first and foremost. The parent gets that right. The grandparent, however, can claim the child if their AGI is higher than the parent's AGI and the parent agrees not to claim the child. Example number 3, 2 non-parents. The 2 sisters form a household with their niece, who is an orphan, and both sisters meet all the tests to claim that child. Only the sister with the higher AGI can claim the child. There's no choice in this situation. If a child does not qualify as a dependent under the qualifying child rules, the law is written such that there's something called a qualifying relative. So we need to, it's a 2-step process. We look at qualifying child first, and then if they don't qualify for that, they may qualify under the qualifying relative rules. So we need to always look at both, unless, of course, they qualify as a qualifying child. Now, qualifying relative is a term that may be a little misleading. We need to understand that this does not strictly translate as a blood relative. This could be a qualifying relative in another sense. It could be a neighbor. It could be somebody that really has no blood relationship to the taxpayer at all. So relative is a term that's a little misleading, and you need to understand that it's not always a blood relative. The first test for qualifying relative is the test as to whether they qualify as a dependent or as a child under another taxpayer. So if they qualify as a qualifying child under another taxpayer, then this taxpayer cannot use the qualifying relative rules. So you basically stop on test number 1 and don't bother going any further because they do not qualify as a qualifying relative. Test number 2 for qualifying relative. Was this person, this individual, a member of the household with the taxpayer all year, or perhaps the relationship can be looked at? Was it a child, stepchild, qualified foster child, or a descendant of any of those? Was it a brother, sister, half-brother, half-sister, son, or daughter of the taxpayer? Was it the father, mother, or ancestor or sibling thereof of the taxpayer? Stepbrother, stepsister, stepfather, stepmother, father-in-law, mother-in-law, brother-in-law, sister-in-law, son-in-law, daughter-in-law. So if it was any one of those or descendants of any one of those, then they would qualify as a qualifying relative. It may potentially be a dependent or maybe a qualifying relative for some other tax purpose. Here are tests 3 and 4 for qualifying relative. First of all, the gross income test. The person that we're considering as potentially being a dependent has to be below the threshold amount. For tax year 2021, that's $4,300. That is going up to $4,500 for 2022. Support. Was the support provided by the taxpayer, and was that support over half of the support of the individual? Now, this test for support is different than the test under qualifying child. Under qualifying child, the question is, did the qualifying child pay over half of their own support during the tax year? This question is different. Did the taxpayer pay more than half of the support during the tax year? So they're just the opposite of one another. They kind of, they're similar enough where they can be confused with each other, but you need to understand the difference. Okay, so what is considered support? The items that are included in support are food, lodging, clothing, education, medical and dental care, recreation, transportation, gifts, and necessities. What you can do if you are concerned as to whether they meet this test or not, whether this individual meets the test or not, you can go to the Volunteer Resource Guide, tab C, page 7, and there you will find a worksheet for determining support. So you can actually go through the worksheet and determine whether this individual meets the support test or not. Here are a couple of handy points to remember when trying to calculate support. The Social Security benefits that are received by the child in the child's name are considered support provided by the child, not by the parent. However, welfare benefits that are paid to the parent in order to support the child are considered support provided by the parent. So even though it was paid by welfare, it was paid to the parents, so therefore it is support provided by the parents, such as temporary assistance or needy families or food stamps, SSI, those kinds of things. So just a couple of points to keep in mind. When calculating the gross income amount for the possible qualifying relative, the $4,300 or $4,500 in 2022, you probably want to use a resource, the Volunteer Resource Guide 4012, tab A, chart A, and look at the footnotes that they define the gross income. So if you're not sure what income qualifies as gross income, please look at tab A, chart A, and also there's tab D, income quick reference guide. So you can see a quick reference guide to gross income there on tab D as well. So I would suggest, I point you to both of those resources to determine whether the potential individual has more or less than $4,300 for 2021 or 4,500 in 2022. So that's it for this, and we're now moving on to the next presentation on the resource tool.